Hello and welcome to my lecture. In today's lecture, we are going to discuss the very important topic of corporate finance, and that is business valuations. Business valuation. This is very important topic, and is business valuation practices are highly practiced values in the corporate world. So, if we talk about the basic meaning, what is business valuation? Business valuation simply mean a company or another kind of business firm, and for valuation to assess the fair value of the entire business at which it can be valued. This is the basic business valuation meaning. So it is also important to understand what is the purpose of the business valuation. So we need to look in the purposes of the business valuation. Why do people perform business valuations? This is the main question, that why business valuation is going to perform. For example, here is the group of investors, right? And there is another company that is operating, but they are having some problems due to, for example, in management problems or market issues or something like that the current management is unable to cope with. So the investees or the target organization should be valued before investors make any investment or put any stake in the business. So this company would be valued with the techniques available in the business valuation. Valued with techniques of business valuations. This is very simple form of understanding the purposes of the business valuation, and there are a few purposes, very common purposes of the using business valuation. For example, to take over other business entity, in this case the investor want to know what is the fair value that they should be paying for the target organization before they acquire them, and they to value the shares of a company. For example, if you are going to invest in Facebook, is a very big IT company, and everyone is interested to buy the shares, but the investors like you and me are small investors and they can only buy few shares. But there are a lot of big investors who buy major stocks in these companies, and they really want to know what is the good share price that they should be paying in order to acquire the major portion of the company. For example, if a group of investor is going to acquire 15% of the shares, they will value the shares with their own approach and with their own assumptions, and they will not only regard the stock exchange price of the share. They will use their own methods. For example, they will use EPS method, they will use the NPV method and DCF method or ARR method. So these are kinds of methods, or DGM, dividend growth model, and DDM method. These are the few methods with which a business can be valued, and these methods typically relates to the listed or quoted company. Listed company is a company that is listed on the stock market, such as London Stock Exchange or New York Stock Exchange. So the other purpose is that, for example, a bank willing to lend money to the business will be interested in knowing the value of that business. So bank or other lender. Management, although management is not going to buy the business, but they want to assess their growth and the increase in wealth. They need to know the business value of the business and need to make changes accordingly. For example, if they value the business with the new assumptions, for example, if the stock price is $50 of a company A, and the future changes like economic political changes are considered for the next 1 year, and these assumptions are applied, and this value could be recalculated something like that 40 or 60 with the business valuation techniques discussed above. So this is the basic introduction of business valuation. I hope you will understand this lecture. See you in the next lecture. Goodbye.